This one candlestick pattern is all you need to filter out noise, spot high probability trades, and stop second guessing your entries. Forget memorizing 50 different patterns like hammers, shooting stars, dojis. None of that matters if you can't use them consistently. Today, I'm going to show you the one candlestick pattern worth building your strategy around. And by the end of this video, you will know exactly how to trade it with confidence. If you don't know me already, I'm Kojak's Pro. I help traders cut the fluff and actually make money with simple, repeatable processes. Let's get into it. Here's the truth. 90% of traders overload their charts with candlestick cheat notes. You've got engulfings, inside bars, morning stars, evening stars, haramis, pin bars. The problem? When you see 20 patterns, you are paralyzed. You ask yourself, which one do I trust? Which one do I trade? That hesitation costs you real money. And here is the kicker. Most of these patterns only work if you add context. Context in the sense of trend context, volume context, market structure. Without it, you are just paralyzed. They are just random candles. And this is why most traders fail, because they look for complexity instead of mastering one single edge. So what's the one pattern that you should focus on? It's the engulfing candle, specifically the bullish engulfing and the bearish engulfing candle. Why? Because it's the clearest signal of a power shift between buyers and sellers. One side is literally overpowering the other, and that's where momentum begins. When a bullish engulfing shows up after a pullback into demand, buyers have stepped in, trapping shorts, and price rips higher. When a bearish engulfing forms at supply, sellers slam the brakes, buyers are trapped, and price dives. This isn't about memorizing every pattern. It's about locking in on the one that reflects real order flow. Let me break down exactly how you trade this, so you're not just staring at random engulfing candles, and I'll be using real chart examples to show this. Step 1, context. Now look at this chart right here. We're going to see here that there seems to be a bearish engulfing candle rather at this zone right about here. So if you look at this bearish engulfing candle here, that just formed here. Now, prior to this price action movement, you don't have the trend with you. You don't know whether it's a bullish trend or a bearish trend. You don't have market structure with you as to know whether there has been break of structure or change of character. You don't have any of that within your graphs as a trader. You just open a blank chart and this is the first thing you see. And your price action book, your candlestick Bible, they all tell you that whenever you see a bearish engulfing candle, you sell because sellers apparently have gained momentum. So imagine what happens once you take this type of trade. I'm just going to pull up the risk reward tool here. You take your sell, your stop loss comes above the wick of the candle, and you aim for the next possible 1:3 or the next support region, and then you take your trade. Now, you would have been clearly stopped out in this trade. That's what happens once you don't have context to your side as a trader. Step 2, confirmation. Like, we want our bearish engulfing candle to completely envelop the previous candle. So this is a case of where you've had your zones marked out. Like in this case, we've got a zone here, and then we've got this zone right here. So you've got these zones right here, and then you've also got another zone right here. So you've got all your zones clearly plotted out in this case, and you've spotted bearish engulfing candle right about here. So we have a bearish engulfing candle right about here. So this bearish engulfing candle now has completely, like if you can look at it clearly, it's completely engulfed the previous candle. And that is what we want. We want a scenario where it completely engulfs the previous candle. We don't want half engulfings. We don't want guesswork. Because if buyers and sellers can't completely take control, I'm not going to enter into that trade. I will not be sticking my money on that trade. Now, in this case, you can see that after we draw up our risk reward tool and decide to hop on this trade, put our stop loss just above the zone, aim for the next support region right about here. This is going to give us a 1:2 on this trade. And then we take the trade. Watch what happens in this trade. You can see that we clearly hit take profit right about there. Simple. Follow the context and wait for your confirmation. Step 3, entries and stop. Where do you enter? How do you place your stops? You should enter at the close of the bullish or the bearish engulfing candle, as the case may be, and your stops go above the wick of the candle. This way, it keeps you safe from market manipulation, or just in case the market doesn't go in your favor, your stop loss is minimal. Step 4, target. Where do you aim for in the market? Ideally, aim for a 1:2 or a 1:3, as the case may be. Most of my trades are usually 1:3 and above, sometimes 1:5, 6, 7. I've gotten a trade before where I aimed for a 1:11, and obviously those kind of scenarios are hard to come by. And even a risk reward of 1:3, most times it's not always feasible to get them consistently. So you go with what the market gives you. Sometimes the market might just give you 1:1.5 or 1:2. But ideally, in terms of being overly profitable, you should aim for a 1:2, 1:3 and above. Now, you should understand that bullish engulfings and bearish engulfing candles have a shelf life. So don't get greedy. Just aim at that and take your profits whenever it hits those take profit regions, or maybe close your profits partially and allow the rest of the trades to run. That's how I trade, and that's the best way to go about this. When you follow these 4 steps, you filter out 90% of the noise and only take trades where the market is actually showing you where to go. Now, here is where most traders blow it with engulfing candles. 1. They trade them on tiny time frames. Noise dominates on the 1-minute chart or the lesser time frames. Stick to taking trades on the 1 hour, the 4 hour, or the daily. 2. They ignore context, just like I've showed you. Imagine trading engulfings in the middle of a chop. I mean, that's not trading, that's gambling. 3. And the most important one, they forget risk management. Even the best pattern fails. If you're not risking small, one bad trade can wipe out an entire week's progress. Now, what should you take from all this? Trading isn't about knowing more patterns. It's about mastering one. When you simplify, you get clarity. And when you get clarity, you finally trade with confidence. The engulfing candle is just the vehicle. The real edge is in your discipline and consistency. If you got value from this, don't just binge the next video. Put this into practice. Mark out your levels, watch for engulfings, and stick to the plan. I promise, trading becomes 10 times clearer when you stop overcomplicating. Download my free guide, Price Action Secrets. It will walk you through how to read the market without indicators and make this pattern even more powerful. Subscribe if you want real trading strategies without the noise, and I'll see you in my next video.